is the market just being lifted by one sort of theme right now? But I think what a lot of people don't think about or, put into the equation is that like this is one industrial revolution, and the markets have historically like always been driven by like one industrial revolution at a time. So there was like industrial revolution of like the 1800s, the second industrial revolution, early 1900s. Then we had like the information, technology industrial revolution, and now like the AI side. So like it's kind of like a persistent theme across like history. So it's not like this isolated event that's only happened like just now. It's kind of like persistent, but just the theme changes every time.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2i Capital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 18th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today I'm joined by my co-host, Ryan. Welcome, Ryan.
How's it going?
Yeah, not too bad. It's been a little bit since we've last spoken, and the markets are moving as usual. We had a couple of Bank of Canada and the Federal Reserve interest rate meetings this week. We're in the kind of in the middle of earnings season, peak earnings season. We have a bunch of mega cap tech names reporting. So why don't you kick us off with the market pulse on what's moving the tape and everything market and company related?
Yeah. So lots going on. We get looking at like high level markets. I don't think there's like a whole lot to be overly pessimistic about right now. Rates coming down in Canada and the U.S., which is going to act as a bit of a support to broad markets. Both central banks, Canada and the U.S., came largely what markets were expecting, which was 25 basis point rate cut for both of them. But the Fed offered a bit of surprise with theirs.
Yeah.
With what was the quote they had? Foregone.
The
next cut is not a foregone conclusion. And I think they said that a good like 20 times in the press conference that they did. So everything was largely as expected. Everyone was kind of expecting the rate cuts, but Powell maybe gave a bit of a jolt to markets by letting them know that, hey, you're trying to price in this rate cut in December.
Yeah,
might not happen.
Not so fast, basically.
So it was pretty funny or interesting that he went out of his way to make that very clear, kind of prepping markets for that, which is a good kind of helps smooth things out.
Yeah, that's true.
Surprise to markets. So, overall, I think everyone likes to talk about rates just because it was such an important thing last year, maybe the year before. But I think it's the rate cut story is sort of over now as well. Rate cuts are going to help, and that's great. But I don't think stocks and markets need rate cuts to work anymore. And honestly, they didn't really need them a year ago to work either, right? Companies have been doing fine at higher rates. Obviously a little bit, things coming down a little bit more to be welcome, but it's not. I don't think it's a requirement for markets to work at these levels.
That's fair.
An interesting thing, I think right now is also comparing Canada to the U.S. on the interest rate side of things is that Canada is at their rates at 2.25% now, I believe, after the recent cut, and the U.S. is at 4%. So I think it's interesting where Canada has maybe spent a lot of their bullets at this point, for if the economy slows down or something like that. At 2.25, you don't have that much more runway to really cut rates where it's going to boost the economy.
Right.
The U.S., they're getting probably closer to that level where they don't have that much room either, but they certainly have more runway than Canada does to kind of give that supporting boost when those bad times, and some bad times will occur kind of thing. So but when those bad times occur, U.S. has a bit more runway, Canada not so much. I just thought it was kind of interesting. You kind of would maybe assume that the two would be at closer interest rates, but obviously they're not. So outside of the rate story, though, we're in the middle of earnings season right now. I think Amazon literally just reported. I don't have any numbers you can give there.
I don't have the quick numbers pulled up, but from what I saw, the post reaction, market reaction was pretty positive, which I think it put it at all-time highs, basically a plus 10% move after hours. So, and yeah, I don't have the figures up yet, but that puts them at basically January 2025 levels. So pre kind of like tariff.
I feel like they've been kind of the overlooked name out of all the Make 7 or Fang names, whatever you want to call them now. But they've been kind of left behind. I mean, they've done fine actually over the last year or so, but they've been left behind with the others. So maybe it's their turn to do a bit better. What else? So we'll go over a couple of interesting earnings in a minute here, but tariff drama still continues, and it's going to be a weight on the Canadian economy and kind of sentiment as well until that really gets resolved. And who knows if or when that'll happen. And we also have a federal budget coming in early November, it looks like. So we'll see what we have in store for that in a couple weeks, I guess. So a lot of mega caps reporting now. So NVIDIA hasn't reported, but they did go through their. They had a big conference recently, and some news that they released helped them hit a $5 trillion market cap. First company to hit a $5 trillion market cap. So that's noteworthy, and really like in the just kind of looking at different keynotes and speaking sessions at that conference it really looks like it's all systems go on the AI front. They're not slowing down. Companies aren't slowing down on the investments on the AI side of things. So there's certainly quite a lot of optimism in that space. And I think it's funny on the market cap side, you have $5 trillion market cap. It's like, what does that even mean now?
No, yeah.
So I know it does. It's not mean. I know it's kind of meaningless.
It's basically meaningless. Yeah.
Like, how do you size that up? And so comparing it to like GDP of economies doesn't really make a whole lot of sense. But I think that's just like an interesting way to help you frame like the scale of what these companies have become or whatever. So like the GDP of Canada is in US dollars is like $2 trillion essentially.
Yeah,
right?
so it's 2.5.
Yeah. So it's just like just staggering numbers.
Yeah.
So that's NVIDIA. Google, they actually probably had the best, at least in terms of what the market viewed it as, had the best results of all of the mega caps so far. So the revenue was about 102 billion. They did 99.8 billion was expected. So markets like that. EPS, earnings per share, was 3.1 versus 2.33 that the markets expected. So just it was a pretty solid quarter, and their cloud revenue came in, which markets are really focused on right now. So cloud revenue came in at about 15.2 billion, and they were kind of looking for 14.7 billion on that one. So and again, just another kind of touch point on strong cloud revenue and demand for AI overall. Meta kind of took a bit of a different tack where in terms of how their shares did. So they got hit. I think they're down 9 or 10% after their earnings. But honestly, the earnings themselves look pretty good. They did 51 billion in revenue. Markets were looking for 49-ish. Earnings per share was at $7.25, and markets were expecting about $6.70, let's call it. Companies Meta's really leaning heavily into AI, and I kind of get the sense that maybe they think, or they're worried that they've fallen a bit behind on the AI story. So they had a kind of an interesting quote of their AI, their capex in general next year is going to be notably higher. I know what it was.
Basically, like high enough that we don't know how to forecast for it because it's going to be a moving target.
So I think they're really leaning into the AI investment. That spooked markets a bit, and that's kind of what sent them lower. And in fairness, I think they, some of the concern is warranted because they did a big investment cycle into like their whole metaverse push. And not a whole lot really, not a whole lot really came out of that. So I think markets are maybe getting a little bit worried that we have metaverse 2.0.
Like a PTSD from that event, basically. So,
Microsoft also reported good, just following suit here, good set of results. $4.13 in earnings. Markets were looking for $3.67. 77.6 billion in revenue, which beat the estimates as well. The Azure is that like their cloud business was what is always with all these companies right now. The cloud business has kind of been the focus, but their revenue growth was 40%, and markets were kind of expecting 38%. So I mean, it's just small, short-term, quarterly kind of stuff, but overall, these results look pretty good. And same kind of trend here where. There was notes from the management team in their conference call about how they can't keep up to the AI demand right now. So that they will also very likely be investing heavily in the AI side of things. So you kind of put all these things together, and it's if you're worried about AI being in a bubble or if the growth is going to continue there, it's the demand's certainly still there, and all these companies are kind of shouting it from the rooftop that we're billions and billions of dollars are still going into this space kind of thing.
Yeah, no, for sure. And I have Amazon's numbers here. So EPS of $1.95, beating estimates of $1.57, and then sales of 180 billion, beating estimates of 177.8 billion. So it was, AWS growth was, I think, 20% ahead of 18% estimates. And then sales were up 13%. So pretty solid numbers there.
Nice. As well. Yeah. Nice. I will, while I'm on it, I do own shares in Meta and Amazon as well. So just for full disclosure there. One other company, which I don't actually follow this company that closely, but that I think is worth mentioning, we were talking about this earlier too, is Fiserv as well. So they are a financial services and payment processor, and they reported earnings, not a great earnings report, and their shares went down 40%. And I think this one's an interesting one to highlight just because it's something that I see a lot where people look at cheap valuations of stocks and think that low valuation provides you protection. But oftentimes the low valuation is telling you something, and there's something maybe bad in the business. And then when that bad thing happens, there's nothing there to support the shares, right? So it's a lot of these companies, they lack optionality because typically, maybe they're slow growth to begin with, or maybe they have high debt or something like that. But so when that bad news happens, they have no other levers that they can really pull to get growth going or to pay down that debt that's now becoming a really big problem, right? So it's that lack of that optionality for those at face value cheap stocks can really hurt over time. So it's you obviously want some valuation protection. You want to own stocks where the valuation makes sense, but oftentimes when it's that in your easy to find at face value, cheap PE type of stock, it's almost too easy, right? And oftentimes I see at these cheap names when they have bad earnings, they almost get hit the hardest, versus more kind of at face value expensive names would,
because it's basically like the market's telling you something with its cheap valuation, and like the cheap valuation can always get cheaper, but also earnings could decline, price declines with earnings, and all of a sudden PE is still flat. But yet, shareholders lost money in the meantime. So
I think it's just a good one to point out because I see it a lot where people think that the low valuations provides you protection, but it's like a false sense of security, right? And it gives you this false sense of comfort too, where you can maybe size that because it's cheap, so I can own it in a bigger weighting. And it's almost the opposite of what you want to do with these names, because if whatever markets are pricing it lower, if that risk actually comes to fruition, then it gets really ugly really quickly.
Yeah, no, for sure.
That's most of my my company updates there. I think I got for you for now.
Okay, nice. Yeah, no, it's a great segment on market news, company news. We have a lot going on. We're heading into the final months of the year, so everyone's kind of keeping their eyes pretty peeled on anything economic data related or company specific. So I'm going to go ahead into the tweets of the week segment here. So I have two tweets that I wanted to showcase. So I'm just going to change the layout there. I'll put that bigger on the screen. Okay, yeah. So this is a tweet from Donovan Jackson. It's at the Don Investing. So he's looking at offensive industries or sectors versus defensive sectors. So it's the ETFs are XLK, XLI, XLC, XLY, XLF. So that's tech, industrials, communication, discretionary, financials, essentially all of the like cyclical type of sectors, very offensive type of sectors that do well in bull markets and strong economies, and then divided by consumer staples, healthcare, energy, real estate, utilities, more of like the predictable, stable, kind of defensive type sectors. So the black line is essentially the ratio between that two, between offensive versus defensive, basically since 2020. And then he's also highlighting the VIX. And he's kind of showing that when this ratio, bottoms out alongside these like VIX spikes, usually that was some sort of like broader market bottom. So we saw it happen with the COVID bottom, big VIX spike, and that whole ratio kind of went down. And similar with 2022, and then Liberation Day with the tariffs in 2025. So it's pretty impossible to time these bottoms in real time, and also when the VIX spikes happen. But I thought it was really interesting just looking at that overall ratio and the trend, because we can see that the ratio between offensive sectors and defensive has really been in an uptrend since the 2022 bear market bottom. And that's really like the crux of this whole bull market we've been in since then. Like, this chart is making higher highs, higher lows, like exactly what you want to see in a bull market. That's an uptrend. And so really my thesis is kind of like, until that, trend essentially breaks and we start to see that head lower and make, lower lows and lower highs, really, the bull market seems to be intact. And, we're seeing these high growth areas really outperform. So that's kind of the picture that we're looking at for this bull market essentially is really this chart.
And so growth, black line moving up means growth is outperforming, essentially, right?
Like cyclical outperforming. Yeah.
Okay. Interesting.
So it's pretty healthy looking chart, and really just kind of showcases bull market is intact so far. So yep. And then the next tweet, this is from Ryan Dietrich. So I'm just going to pull that up here. So that's at Ryan Dietrich. So he's a really interesting, individual to follow on Twitter. He does a lot of like statistical type of analysis, looking at a lot of like historical kind of analysis. And he has this line chart, and this is essentially the average path of the S&P 500 for the year. So like he took all years of the S&P 500 since 1950 and just took the average. So what does it look like on a percentage scale? So we can see that basically the average year, it looks pretty good up until the month of, the end of October. It does kind of flatline on average between August to October. And then we can see this like massive ramp up from November to December on average. So I thought that was really interesting, is showing that, stocks historically bottom on average on October 27th. And then we see this nice ramp up into the end of the year. So I think there's, a lot of structural issues for why that happens. Like, funds can sometimes chase into year end. We see them, if they're underperforming, they want to get into like higher growth names or areas where they haven't been exposed to, but they know that the market is exposed to that and performing well. And there's other reasons, like, everyone operates on the calendar year for, investments really. So everyone looks at like their statements as of December, the end of December. So everyone really wants their performance to look good by then. So I think there's a lot of structural reasons for it, it's a really like psychological kind of thing as well. So, I think that's pretty good. That's well for the next 2 months.
That's sort of following what October's done. I think saying October's kind of a flattish type of month, and that's sort of what we're seeing right now. And even we're the 30th, so stocks had a bit of a rough day today. So it might be kind of about 2 days later, whatever, on the bottom, but might be following the pattern there.
I hope so. Really hoping so. So that's tweets of the week for me. And then Ryan, I think you have some dividend, the dividend radar going on.
Okay, dividend radar. Yeah. So always when earnings season happens on the Canadian side of things, you get a lot more dividend announcements. So not too many here, but we got Alaris Equity Partners, ticker AD.UN, increased their distribution by 9%. Covalon Technologies, a bit of a smaller name, but they declared a special dividend for 15 cents per share. And this works to roughly like a 6% yield on just that single dividend. So shareholders should be pretty happy about that. I'm not special dividends are interesting. I'm not a huge fan of them because I think I would prefer the companies to just reinvest their capital in their own business. Like you own that business for a reason, because you want exposure to whatever they're doing and they're growing that in that vertical. So typically I'd prefer them to just reinvest that and grow internally, and also it's less, or it's more tax efficient as well because the dividends aren't leaving. But it could just be also that management feels that there's that is the best use of capital as well. So interesting. Anyways, again, I'm not a huge fan of special dividends, but I don't complain when they have.
That's right. 6% one-time boost for those guys, I guess.
Yeah,
not too bad.
Waste Connections had a dividend raise as well at 11%, and then a first dividend alert, which we always like when we see a brand new dividend. It's just a signal that a company's kind of waving their arms saying, we're here, we have stable cash flows, we can afford this dividend. So it's bit of a mouthful to say it was CareRx Corporation.
CareRx, bit of a tongue twister, I guess.
The ticker, and they initiated a 2-cent dividend.
Nice. Yeah, solid list. Yeah, some names that we don't normally talk about there too, so that's good. I like it. Okay, awesome. And then I think you have 2 Q&A questions you want to go through. So this is kind of our segment where we do like the 5i Research Q&A spotlight, essentially looking at what investors are asking. So yeah, if you want to kick it off with your...
Sure. Yeah, so this actually kind of dovetails into the valuation with Fiserv that we were talking about earlier, sort of. So the question is, how much importance do you place on the CAPE ratio when making investment decisions? If someone was, looking to make a change with their CAPE, how concerned should they be if it's high versus what your forward equity returns are going to be, that kind of thing. So with anything, I don't think there's any bad single metric out there. Everything is a different tool or a different data point to use in your tool belt or your toolbox. So on that side of things, it's fine. But above and beyond that, I'm not really a huge fan of the CAPE ratio. I don't think it's overly helpful. It's certainly not helpful on timing. I think over the last decade, it's probably told you consistently that markets are overvalued. Which is fine, but what are you going to do with that information over the last decade when markets have only gone higher over that
sideline basically the whole time?
So I think, just on that fact alone, it's hard to look at the CAPE and say there's a whole lot of value or signal here, regardless at this stage. And honestly, you don't. Everybody, and I don't think markets are particularly overvalued. They're not cheap, but you don't need the CAPE ratio to look at the market valuations and see that. Like they're kind of telling you the same thing. Yes, their valuations are rich, kind of thing, but you can look at just the plain market valuation to see that too, right? Like the CAPE, I don't think is really adding a whole lot of extra signal. And so what's the real reason I don't really like this ratio, and you see when people just look at valuations in general, is that the look back period on this is too long. So CAPE looks back a decade, I think, over 10 years. I might be wrong on that, but I'm pretty sure it's a 10-year look back on the average PE that they're looking at, and it's just too long of a period, right? It doesn't take into account that the structure of the markets changes. So what's changed over that time? You've had big tech companies that are some of the strongest companies that we've ever seen in our history of public markets become a large portion of the market, and also technology in general is higher growth, typically more stable cash flows, and a higher margin business than almost all other industries. And what does that mean? That means that those companies rightfully are going to be awarded with a higher valuation, right? So of course, in a more recent term, markets are going to look overvalued when you're comparing it to valuations 10 years ago when these companies weren't nearly the same type of beasts that they are today, right? So it's using out of date information and not really helping on a forward-looking basis.
Yeah.
So, and you see this a lot too. People just call it long-term averages on valuations. They'll say the S&P 500 should trade at a 15 times forward earnings or 15 times earnings type of valuation because I've looked at valuations back from the 1800s.
Yeah, that's right. Yeah.
Okay, fine, but a lot has changed.
Yeah, the sectors, the industry breakdowns, like everything. Yeah.
And I mean, you have to be careful that you don't want to just make excuses for why markets should be expensive today or anything like that.
Right.
You want to be careful you're not doing that, but you also need to look at it and say, okay, has the actual, like, what has actually changed over the last 10, 20, 30 years?
Yeah.
Should what we apply or expect out of a valuation today be the same thing that we expected in the 1850s or whatever, right? And it's obviously no. So
yeah, and like, I mean, I think valuations are useful and helpful, but I've also really never seen anyone like correctly time a top of like a stock or the index based on like valuation. Like, valuations can always expand and they can always stay high, and it's just really not like a good like timing indicator, like you said. So yeah. I agree.
You want me to the next question?
Yeah, sure.
Okay, so I've been seeing this a bit lately. So it's the question is, obviously AI has boosted the market and the economy to new heights. What if we took AI out of the equation? Is the market or is the economy in a recession or something like that? That's the general gist of the question. And my answer is really just doesn't really matter, right? Like we don't live in the alternate reality, so I don't think it's helpful to start Xing out certain areas of the industry that are or maybe are not driving the economy, and then using that as a reason as to why you should be worried about the economy or the market or whatever. The AI investment is here, it's real, and it is having some impact certainly on GDP growth and things like that. But whether it's helping the economy in general, and it has multiplier effects into other industries as well, right? And I think the other thing that people miss here is that capital needs to or should or will go somewhere, right? So that capital was there to begin with.
Yeah.
And so maybe if it's not AI, maybe it's going into reshoring or onshoring, or maybe it's going to share buybacks or dividend increases or whatever it is. But just because, so yes, AI is there and that's soaking up a lot of the capital that's available, but it doesn't mean that capital would not have found other
other productive, sort of like innovative. And
I mean, and you can have an argument about what is the better use of capital. Is AI, or is all this AI investment the best use of the capital?
Right.
I mean, so far it probably seems like it is probably better than share buybacks, I think.
100%.
Right. But so you can have that conversation, certainly, but I think that's in that question that a lot of people are starting to figure out. This is the one thing that's getting missed: is the capital is there to get spent and reinvested somewhere, and it would be going somewhere somehow, kind of thing.
Yeah, and I think what I'm kind of seeing a trend with this question, and like this whole like concern about like, oh, what if AI didn't exist? Like, what would happen? Like, is the market just being lifted by one sort of theme right now? But I think what a lot of people don't think about or put into the equation is that like this is one industrial revolution, and the markets have historically like always been driven by like one industrial revolution at a time. So there was like industrial revolution of like the 1800s, the second industrial revolution, early 1900s. Then we had like the information, technology industrial revolution, and now like the AI side. So like it's kind of like a persistent theme across like history. So it's not like this isolated event that's only happened like just now. It's kind of like persistent, but just the theme changes every time, basically.
Yeah, no, I think that's totally fair. And at some point it will get a little too silly kind of thing, right? Yeah. And I think we're still pretty far away from that, though.
Yeah. No, I like it. Cool. So I'll go into my 4 questions here. So my first one, so kind of on the same sort of topic about like bubbles and everything like that. But, in the 5i website, we had a few members asking about, bubbles and like, what do you define a bubble as? And we got into a bunch of threads on that. And then this one user asks or mentions really that, a bubble for me is defined by our taxi driver or plumber telling you how he's made $1 million in the stock market and is going to quit his job to trade stocks for a living. We're not there yet. And so we basically said, yeah, we agree. We think there's signal. If you basically keep hearing about certain investments or themes in one's everyday travels, that could be a good sign that the theme's gone mainstream and everyone who can have exposure to it already does. But, sometimes, investors can go searching for that kind of like confirmation bias. So like, you hear it from someone that but really they're like an investor and they already know about NVIDIA. But really it's when like, your second relative that you rarely talk to who, doesn't invest at all and has never expressed interest in investing starts talking about like data center stocks. That's likely some sort of, early indicator or some sort of indicator that it could be a market bubble. But
when grandma who's never barely even invested in her life or whatever is texting you about these interesting stocks she's seeing on the TV or something.
Exactly. Yeah. So, and I've been hearing a lot about it, and I really like resort back to the saying that like bubbles don't happen when everyone's talking about them. That's the whole thing about a bubble is that you can't see them. So kind of.
I like the caveat here about you can't search out for your anecdote either, like because you can find that Reddit, whatever, you can find it anywhere right now, right? So but I remember in the pot stock bubble, I don't know how long ago that was nowadays, but it was like I think I was actually going I was just sitting in a coffee shop getting ready for a BNN appearance, and in the coffee shop two different groups of people came in and they were talking about how much money they made. It was that moment. I'm like, wait a second, what's happening? And then I kid you not, that night I went out with some friends, and then the Uber driver, literally, it was like the taxi driver pitching me with stock. The Uber driver was literally pitching me on like pot stocks or something. I was like, oh my gosh, it's happening. So and it was actually, I mean, I'm kind of guessing on time frames, but it was less than 3 months when that bubble popped. So it was pretty interesting. So it sounds so silly, like as a signal or using these kind of anecdotes, but there really is some type of signal to it for sure.
It can be a good real-time signal, and so I'll just wait until I hear someone in the real world talking about quantum randomly, then I'll start thinking about there's a bubble. And then question number 2 for me. So this is just a kind of usual question that we get on our platform. So we get this question. The member asks, what are your current top 5 stocks to buy today from the growth portfolio? So it's a growth model portfolio that we run. Cheers and thanks, Chris. So we mentioned, today our picks would be P&G, which is Kraken Robotics, CLS, Celestica, Galaxy Digital, Go Easy, and Zedcor. So obviously, timing's everything. These names have done really well in recent history, but I think they're also like operating in really important themes right now. So Kraken Robotics and underwater autonomous system, like submarines and drones and things like that, and radars and battery technology. Celestica is operating in the like hyperscaler data center AI chip sort of space. Galaxy's like the investment bank for crypto. Go Easy is serving underserved Canadian consumers, and then Zedcor is kind of on like this mix between AI and security, and like monitoring and things like that. So a little bit of tech, a little bit of AI, some drone exposure. So some really interesting names. None of them are cheap, with the exception of maybe Go Easy. I think, we'll see some volatility alongside these names, but I think, when we look out like 5-10 years, these can probably do fairly well.
Yeah, big caveat. Obviously, these are smaller, higher risk names, higher volatility for sure. But all interesting, all really hitting a really good growth pace as well. So I do think Kraken's just, it's the company itself. What they do is just pretty interesting. The whole drone trend, I think, is one to really dig into. There's more drone exposure. You can find more drone exposure on the U.S. side for sure, but and I think honestly, Kraken might be the only drone pure play-ish exposure in Canada. So
yeah, for sure. Yeah, and it's got a huge like U.S. exposure as well for sales and things like that. So that's good. Okay, great. Yeah, so we will head to the next section, which is okay. So this is the stock deep dive kind of segment of this show where we highlight a 5i research report. So this is Propel Holdings. The ticker is PRL. So we wrote a research report update on this company recently. And it's really evolved from operating under the brand of just MoneyKey as this like SaaS loan management system for online unsecured loans to now having its own underwriting capabilities, its own lending platform. It operates through a few different segments and brands. So one is MoneyKey and then Credit Fresh in the US. It now has Quidmarket in the UK and Fora in Canada. And it provides loans for, US, UK, and Canadian consumers who are traditionally considered underserved in the traditional financial system. So they essentially can't really qualify for, loans or any sort of financing with a traditional bank. Their credit scores are just a little bit lower, but they can access some form of credit through a company like Propel. It did really well last year. It rose from around $13 a share to the mid 30s throughout the year. It pays a nice, healthy dividend yield of 2%. It's growing its dividend at a healthy rate. It's faced some challenges this year, though, with fears of lower rates. That's kind of acting as a headwind now for its business model. There's like a rise in delinquencies, which is causing some fear in investors, particularly around this consumer lending space. So yeah, its performance hasn't been great. But what I find most interesting is that, it's a Canadian listed stock. So investors might naturally see the delinquencies rising in Canada and think that, I should sell Propel, or its business isn't going to do well because Canadian consumers or the economy, et cetera. But in reality, its Canadian segment is actually only like 2% of its total sales, while most of its sales and growth comes from the US. And especially now with Quidmarket, a lot of its growth is coming from the UK, which is showing an economic expansion. And it's estimating that Quidmarket could do 50% top line sales growth. And yeah, it's this interesting name that, provides loans through its own capital, but it also offers tech, platforms that banks can basically just lend money through. And so it just earns a fee by acting as that intermediary. So really interesting name. Growth is pretty good. It's growing its margins. And I think it's kind of unfairly sold off, but we'll have to see at its next earnings report, really.
I think a lot of people also forget that these companies tend to do better in a weaker economy, right? Because you need to, people, for better or worse, or for worse, I guess, but need to stretch to find financing ways to afford their investments, groceries, whatever it is, kind of thing. So and oftentimes with the banks, the larger banks start tightening up their credit standards, so you actually can get higher quality borrowers coming down the funnel into these types of lenders. So you can actually have the credit quality could improve in theory as well. So it's not that they're going to do great in a bad economy, but I think they can do better than people think would expect to do in a slower economy.
Yeah, that's totally fair. Yeah, I like that, and it's it's able to pay its 2% dividend. It has enough cash flow for it, so it's a pretty nice little name there. But momentum's been weak, so really we like to let those names settle, find some sort of price floor before really jumping in, so to speak. So that's kind of where that one's at. But yeah, and then lastly, I want to talk about an investor edge, quick lessons from the field sort of thing, investor education piece. So this one's, I'm pretty excited about this one. So I'm going to be talking about Polymarket. So for those unaware, Polymarket is a decentralized prediction market. It essentially allows users to bet on the outcome of real world events like elections, economic indicators, or world events. And so really, it's kind of like a sports betting site, but instead of just betting on sports, you can bet on basically any event in the world, geopolitical, etc. And really the revelation of the Polymarket and this whole movement is that it's using the wisdom of the crowds. So it's aggregating information from collective beliefs about the probability of events. And it's based on real dollars. So people are putting their own personal money into the outcome of the events. So they're putting their money where their mouths are. That's kind of, why I think this platform's so useful and powerful. It's basically you're getting information from experts all around the world, in every field and industry you can think of. So there's always someone that has more knowledge in a subject or matter than someone else. So if they think an event on Polymarket is mispriced, they can bet on it, effectively making that market more efficient, kind of like how the stock market works. So I want to showcase, this is kind of just the homepage of Polymarket, what it looks like. So you can see some of the events there, and some of the probabilities that it has. But I wanted to showcase kind of this accuracy stat that it released. So it showcased its accuracy prior to resolution for all events that it's had on its website. So we can see some really impressive numbers here. Like, for example, 4 hours prior to the resolution of event, Polymarket odds were 95% accurate. 12 hours, 90%. 1 day, 89. 1 week, 89. 1 month out, 91% accurate. So really impressive figures. And I mean, it just showcases that, this is slowly beginning to likely replace the news in some facets. So we're starting to see, elections being called by Polymarket earlier than the news or anything like that, especially with some other events. So I wanted to pull up one as an example. So it's been running the Bank of Canada decision in October odds for the last month. So this is the chart of the odds that it had for the last month. And so essentially that orange line is the odds of a 25 basis point cut. And then it's like a blue purple line. That's the odds of no change. So no cut, no raise. So what we can see is that, 5 days in advance of the actual Bank of Canada rate decision, it was pricing in 95% odds of a 25 basis point cut. So, for most people in finance that are really involved in it day to day, or look at the swaps market or the bond market, they could tell that, the Bank of Canada was going to cut rates most likely. But for people that are maybe not so inclined to look at the swaps market, they might be unsure, like maybe it's a coin flip for them. But really, when we looked at Polymarket 5 days in advance, we saw 95% odds. And, kind of the flip side to this, if someone thinks, oh, there's no way it's 95% odds, they could bet against that and, potentially receive a 20x return. So it's really a really interesting platform. And I think it's going to be increasingly useful for gaining an edge in certain, financial, economic, or geopolitical election type decisions and events that could impact the markets.
It almost looks like you could argue it's pretty inefficient though too, right? Like for the Bank of Canada decision, you would think, I'd say early October, it was pretty certain that they were going to be cutting rates. So you think it'd be higher than outside of kind of 50, 60% prior to the 19th or whatever, right? So you just think that it would be a bit more, a bit higher of a odds of a cut that close to when the cut was actually happening. If this was 3 months ago, sure.
Yeah.
It's kind of interesting.
So it's this particular market as well was fairly illiquid, really before a week out, they'd only had like $60,000 in the odds here. So pretty illiquid. And also a lot of it was based on two real economic data points. So I think around that October 12th date, we saw I think it was the unemployment numbers came out, which were pretty strong. So then the odds of a cut like dropped. And then after that, everyone kind of realized, okay, they might still cut, even though the economy or the employment numbers might be strong. And then similarly with the October 21st, that was the inflation numbers that came in kind of hot. So then it priced in for a brief period of time, that there might not be a cut, and then it quickly reversed that. So I think, it's certainly like not a perfect system, but, and there's some, inefficiencies and mispricings from time to time, but that's kind of the beauty of the markets, I'm thinking.
Yeah, it's, I mean, and we have no affiliation with Polymarket.
Right.
But Polymarket and Kalshi's the other one as well.
Yeah.
They're going to become a bigger and bigger part of day-to-day life, I guess. I don't know if it's a good thing. I mean, I don't know if we should be able to bet on every trivial or non-trivial outcome, but it's happening whether you like it or not, I guess.
That's basically it. No, it's a good point. And not everything we should be able to bet on, but I think even, I'm not entirely sure on this, but I don't think Canadian residents or even US residents can use Polymarket right now. I'm not sure, but
I think you're right.
Yeah. But I think eventually that seems kind of inevitable. But interesting little stat. And I thought that was kind of interesting for, potentially gaining an edge in some of the markets. So.
Yeah, and to be clear, we're not saying go out and start betting on Polymarket or Kalshi or whatever. It's just the trend itself is the developments are interesting. So
good for gaining information. Yeah. Awesome. Okay, so I think that's all. Is there anything that you wanted to add, Ryan? Or
no, I think that's it.
Yeah.
Just what's the 30th here that we're taping this? So I got Halloween tomorrow and a big Jays game as well. So go Jays!
Let's go.
Probably by the time this is out there, we'll know what the outcome is there. Maybe we'll check Polymarket to see what they're saying for the Jays game. But that's all I got. Go Jays!
Sounds good. All right, awesome. Okay, well, that's all that we have for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time.